Want to grow your wealth? We make finance and the stock market easy. Grow your wealth with AI. For the best financial content, subscribe to the Dollar Explainer.
Welcome to this explainer. Today, we're diving into the literal mathematical magic of wealth creation. You know, we live in a world that is just totally obsessed with instant gratification, fast money, and get-rich-quick schemes. But today, we're going to block out all that noise. We're looking at the hard, undeniable data to prove exactly why time in the market absolutely always beats timing the market. And we'll see how simple, everyday patience is actually your most powerful financial asset.
Okay, let's dive right in by asking the ultimate question that completely intimidates so many beginner investors. I mean, when you look at the stock market from the outside, it can kind of feel like a rigged casino, right? Like it's designed only for the Wall Street experts. But what is the true secret to building long-term wealth? What if I told you it really isn't about picking the perfect stock at the perfect time, but simply about time and momentum?
Benjamin Franklin actually hit the nail on the head centuries ago when he said, "Money makes money, and the money that makes money makes money." It sounds repetitive, but this brilliantly illustrates our core protagonist today, the sheer power of compounding. Compounding happens when your returns generate additional returns, not just on your initial investment, but on all those gains that have piled up over the years. It's exactly how Warren Buffett built his billions, by the way. It's like a giant snowball rolling down a mountain, gathering mass and speed until it just becomes this unstoppable force. Section 1. The magic of compounding. To truly understand compounding, you really don't need a complex financial model or some crazy spreadsheet. You literally just need to remember this one magic number for mental math: 72. This concept actually dates all the way back to the 1400s, and believe it or not, it remains one of the single most useful tools for any investor today. So here's how the rule of 72 actually works, and it instantly proves you don't need to be a finance guru to forecast your future. It's beautifully simple. You just divide the number 72 by your expected annual interest rate, and boom, the result is the exact number of years it takes for your money to double. So say you're getting a 9% return. You just do 72 divided by 9, which equals 8. Your money doubles every 8 years. It's a fantastic mental shortcut that shows you exactly how exponential growth works in real time. Now this is where it gets wild. Look at the staggering impact of just starting early. Imagine we have two investors. They are both putting away $500 a month, and they're both earning a 10% average annual return until they reach age 65. The only difference? One started at age 25, and the other waited until age 40. The 25-year-old ends up with an incredible $3.19 million. The 40-year-old, investing the exact same monthly amount, ends up with just $669,000. Delaying by just 15 years literally cost the late starter over $2.5 million in lost compounding potential. No way, right? But that's the math.
And if you want to know just how powerful time really is, consider this twist. Even if the late starter earning that 10% return is compared to an early starter earning only a 5% return, the math still strongly favors time. The 25-year-old earning just 5% still retires with $766,000. That is actually more money than the 40-year-old who earned double the rate of return. The young investor wins simply because they let time do the heavy lifting. The takeaway here is absolutely crucial. Time in the market matters far more than your rate of return.
Section 2. The dividend supercharger.
Now, if you think dividends are just some boring footnote meant for retirees, you really need to look at this number. Going all the way back to 1960, a staggering 85% of the cumulative total return of the S&P 500 can be attributed solely to reinvested dividends and the power of compounding. Think about that. When average annual stock returns were lower, like we saw in the 1970s or the 2000s, dividends played a massive role in keeping portfolios afloat. Reinvesting those dividends is literally the supercharger to your wealth engine.
But hold on, before you just rush out and chase the stocks with the absolute highest dividend yields, you need to understand this critical metric to avoid falling into a massive trap. It's called the dividend payout ratio. This is just the percentage of a company's earnings that they pay out to shareholders. A high payout ratio means a company is using almost all of its earnings just to pay that dividend, which leaves very little cash to actually reinvest back into growing the business. So naturally, you'd think the absolute highest dividend yields guarantee the highest returns, right? Actually, wrong. Historical data shows us that stocks in the top 20% of dividend yields, what we call the first quintile, actually underperform the stocks in the second quintile. And why is that? Well, because those first quintile payers have an average payout ratio of 72%. It's often totally unsustainable. If their earnings drop even a little, they're forced to cut their dividend, and that absolutely destroys the stock price. The second quintile payers, they hit the sweet spot with a much more sustainable 49% payout ratio.
This data clearly highlights the absolute winners of the stock market since 1973. Companies that are actively growing or initiating their dividends give you the best of both worlds for sure. They delivered the highest annual returns at over 10%, with the lowest overall volatility. Meanwhile, the companies that cut or eliminated their dividends, they suffered negative returns and just massive volatility. So dividend growers are really the ultimate sleep well at night investment.
Section 3. Mistakes that kill compounding. Now we have to confront the terrible villains of our story, the common mistakes that will quietly assassinate your wealth. The first villain is hidden right in plain sight: fees. Now, don't get me wrong, advisory fees can absolutely be worth it if you're getting holistic financial planning and behavioral coaching. But you really have to watch out for high administrative or expense ratios on your funds. Assuming a 7% annual return on a $500,000 portfolio over 30 years, the difference between paying a 0.10% fee and a 1.50% fee is over $1.2 million. High fees just quietly chip away at your exponential growth over the decades. The second major mistake is totally misunderstanding market behavior. You have to start viewing market volatility as a fee, not a fine. Think about it. A fine is a punishment for doing something wrong, but a fee? That's just the price of admission for long-term exponential growth. When markets drop, and trust me, they absolutely will, panic selling is literally the worst thing you can do. You have to view this roller coaster as the emotional fee required to achieve those long-term compounding gains. And if you ever need a little reassurance to stay on the ride during a dip, just consider the history. Since 1980, the stock market is basically guaranteed to scare you at least once a year. The S&P 500 has averaged an intra-year drop of 14.1%. I mean, that feels like a crash every single year. Yet, despite those terrifying double-digit drops, staying in your seat usually results in a win. The market has finished positive in 37 of the last 45 years.
So, you might be thinking to yourself, okay, well, I'll just avoid the roller coaster entirely and keep all my money safely in cash. Actually, scratch that. That is the third ultimate wealth killer. If you try to avoid stock market volatility by hiding in cash, you are just trading one risk for a much more dangerous one: inflation risk. Sure, holding cash completely eliminates stock fluctuations, but it mathematically guarantees that inflation will slowly eat your savings alive, completely eroding your purchasing power year after year.
Section 4. The ultimate wealth formula. Bringing it all together, let's look at the absolute mathematical proof that patience is the ultimate investing superpower. Historically, if you invest in the S&P 500 for just 1 month, it's essentially a coin toss. You've got about a 63% chance of a positive outcome. But watch what happens as you extend your time horizon. Over 5 years, your odds jump to 89%. Over 10 years, 94%. And historically, over any rolling 16-year period, the S&P 500 has had a 100% win rate. The longer you wait, the closer you get to a sure thing.
So what does this all mean for us? It means the ultimate wealth formula isn't about perfectly timing a chaotic market. It's honestly just about starting. Reinvest those dividends, dodge the high fees, don't panic sell, and just let the unstoppable math of compounding do the rest. Time really is on your side. The only question left is, how will you use it? Thanks for joining me on this explainer, and I'll catch you guys in the next one.